Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Jim Welsh. We're running a couple of days late. You know, we do our week in, week out analysis, Jim, and our meeting. Yeah. But I happened to be in your neck of the woods the other day, and I kind of missed all the shenanigans.
And there were some.
There were some. We had a big jobs report, and we had a bigger ISM number when I was traveling into San Diego. I realized that jobs report moved the market, but the ISM seemed to really catch some people off guard. So what are your thoughts with last week's price action?
Well, it's telling, as you just noted. After the jobs number came in, the S&P was up, I think, 44 points in the first 15 minutes, and then only up 3 points in the first 3 minutes. And then at 15 minutes into the trading session is when the ISM number gets released to subscribers, to their reports. And then at 7 o'clock, it becomes public knowledge. And wages were down in the employment report, which was a plus. But the ISM number really provided the kicker because it dropped from over 56 to 49.5, I think. A very, very large decline. And what immediately happened, Blake, is the idea of, hey, the labor market's still holding up really well. And we just saw this weak ISM number. And boy, that's like the perfect prescription for the soft landing. The Fed won't have to do so much, and they'll be cutting rates by mid next year. And that's really what provided the juice based on the ISM report for the S&P to, rocket pretty strongly on Friday. And we saw some carry through yesterday, before things reversed. So I think the first chart just shows that layout in terms of what happened. So as I said, up 44 in the first few minutes of trading, up only 3, and then the ISM number came out and really goosed. So the point I'm trying to make here is, the ISM number was the bigger push, and most news reports were more focused on the employment report. And yes, that was supportive. The wage growth was revised lower for November from 5.1 to 4.8. December year over year was 4.6. So was that constructive? Was the Fed happy maybe to see that kind of progress being made? Absolutely. The main thing is it's not going to change the arc of monetary policy. And so one of the themes we've had for probably 6 to 8 months has been, if you've been in the business 25 years, you've got a lot of experience, knowledge about the markets and so forth. But even with 25 years, you haven't experienced a 40-year high of inflation, and the monetary policy needed to get that under control. And I think that issue, was very prevalent last year. I think it continues into this year because people are still in my opinion, overly focused on inflation. When Powell, during his Brookings speech, I think was very clear that the Fed's focus has shifted from inflation. The pivot is to the labor market. And so in that speech, he said, yeah, based on population growth, just to keep even, you need about 100,000 jobs. Well, wait a second. December job number was what, 223? Also, you need this to go on. In other words, we need job growth under 100,000, and it needs to persist for many months in order to begin to create some labor slack. So that obviously wasn't delivered with the December jobs report. I think the next chart is of the ISM. And so if the market's reacted, strongly to the ISM number, and this chart kind of shows why. If you look at the plunge in the ISM in March of 2020, based on the pandemic, it's like, wow, okay, that was gigantic. But also if you go back to 2008, you can see a big down move. So initially I'm like, okay, I try to take numbers at face value, but I started thinking, wait a second, this doesn't jive with what we saw in terms of the economy. Christmas sales were decent. We're obviously still getting healthy job growth and so forth. And the factor is weather. Starting on December 23rd, there was a gigantic storm. I think his name was Elliott. They love to name storms these days. It was 2,000 miles wide. And it went from Texas up to obviously the Northeast. Buffalo got buried in snow, but many states, southern states, got up to 4 inches of snow, and temperature drops by 40 degrees in an hour. And I think there were 220 million people affected by this storm, and 130 million people were affected by wind chill warnings and so forth. So my point is, what we're going to see, I think, is that the next report we get for the month of January for services, this number is going to rebound. It's not going back to where it was, 55, 56, but could it jump to 52, 53? Yeah. So my point is, I think, and I haven't heard anybody on CNBC or read anything where people said, that big plunge, that weather may have had something to do with it. Instead, it's, oh my God, the Fed is going to have to react to this.
Right.
And I think it's misplaced based on the unquestionably weather did play a role in, this number's weakness.
Well, Jim,
yes.
if you're, I know we don't just take one data point, especially when you're talking about monetary policy in today's, inflation regime that we're seeing, that's gonna alter the Fed. But we are seeing data. We have seen data weaken pretty much across the board, minus like, employment data stayed pretty steady. But wouldn't you just take a culmination of all this? Isn't this just one piece of the puzzle?
It is one piece of the puzzle. Another piece of the puzzle is the Atlanta Fed does a GDP now. For the fourth quarter, I think it finished December at 3.8%.
Yeah.
So did the economy grow 3.8? No, I don't think so. So I think that number is probably overly skewed to the upside. At the same time, I think it puts in perspective some of the reports that we've seen that's, oh my God, the sky's falling. The reality is consumers still have a chunk of savings. Wage growth is still pretty decent at 4.6% a year. And I think the economy is okay. It's going to continue to soften. I think the real weakness will show up by mid-year, the culmination of all the rate hikes, the raising of lending standards, and people running through more savings. So now all of a sudden they have to cut back on spending. I think all that stuff is going to come together by the middle of this year. In the short term, I think the economy is slowing, but still okay. And that has obviously implications for the Fed, because they're looking at everything in aggregate and saying, you know what, ticking the Fed funds rate higher. They've penciled in 5.1. It's currently at 4.375, because they give a range, 4.25 to 4.5. So they're looking for another, 3/4 of a point to a point more. And I think they're going to feel justified. The other point I've made repeatedly is that the cohesiveness and the messaging by FOMC members, I've never seen anything like it. When you have Daly and Kashkari, who historically have been dovish, talking about 5.1, last week Kashkari, 5.5. They're all singing the same tune as we're raising rates a little bit more, and then we're going to hold them there. Fed funds futures still have them peaking around 5 and then starting to come down. So this dissonance between what the Fed is saying and the markets, oh no, they're not going to do that. They're just not going to do that. And that leads them, I think, to over amp. Oh, look at the ISM number, other softer data points. Again, I'm not saying the Fed is right or wrong in terms of what it's doing, but this is what they're saying they're intending. And the markets haven't listened for most of 2022, and I don't think they're listening now. And obviously there's implications to that. The other issue, which is interesting, and again, you and I have talked about this, I've written about this, financial conditions. So the Fed uses financial markets in a sense to, if you will, deliver tight monetary tightening or easing. Stock prices go down, that's tightening. Bond prices go down, yields go up, that's tightening. The dollar strengthens, that's tightening. Yield spreads widen out, all that's tightening. So what we can see is since, call it September, October-ish, financial conditions have eased almost back to where they were in June. Well, that was, 125 basis points? No, maybe 150 basis points of tightening that the markets, because of what they've done, have eased financial conditions. And to me, it was kind of extraordinary that in the FOMC minutes, they had obviously, discussion. When they say participants, that means like just about everybody. And if driven by a misperception by the public, they didn't say Wall Street, but that you could supplement that word, of the committee's reaction function. So as financial conditions ease because people think the Fed is going to do something that they're saying they're not, then that works against what the Fed is attempting to do through financial conditions to slow the economy moderately. They're not trying to create a recession, and that's why the idea of getting up to a modestly restrictive and then hold it. They're not just going to keep willy-nilly jacking rates up and do what that was done in the 1970s. But for whatever reason, part of it is the Fed was completely wrong about transitory inflation. People have been conditioned the last 20 years that every time things get a little hairy, the Fed cuts rates.
Yeah.
But they could do that because inflation was near 2%. Now it's still 6%. So I think, again, those are the misperceptions. But the fact that the Fed discussed this at length, I think, is important. All right, non-inflationary rate. Why is the Fed now so focused on the labor market? This chart shows the non-inflationary rate. In other words, if the unemployment rate is below that red line, that should generate labor market tightness, wage pressures, which obviously feeds into inflation. If the unemployment rate's above, you're going to have labor market slack. Labor wage inflation isn't a problem. You can see going back, obviously 2020 is kind of a weird event because of the pandemic. But if you go back to the last 40, 50 years, each time the unemployment rate has been below the NARU number, the red line, the Fed is raising rates, and ultimately it leads to a recession because historically, to bring inflation down meaningfully, you've needed a recession to really relieve the price pressures just in the overall economy, but also obviously in the labor market. So the Fed has said they're going to raise they expect the unemployment rate to go to 4.6. NARU right now is at 4.4. As you may remember, September, what did the Fed think they were going to go to on the unemployment rate? 4.4. So to me, again, these are the things that the Fed is looking at and why they're so focused on the labor market. And what it implies is they're going to follow through on most of what they're saying. We're going to raise the funds rate a little bit more, and then we're holding it there. And until proven otherwise, that's their game plan. And until I think the markets fully recognize that there's a true recession risk with what the Fed is doing, I think they're just overly optimistic. They keep coming up with narratives that are always bullish. And then in the last 6-8 months, it's like, oh no, I guess that's not going to happen either. I think, at some point in time, equities are going to recognize that the Fed is serious. They're going to hold the funds rate. And to me, there's a window of time, Blake, that you and I've talked about, where we are going to get, as we get into the second quarter, more data that really does show the economy slowing. And the Fed is still going to say, we're not easing right away. We want time to allow inflation to really ease, because that was what happened in the 70s. They overly tightened, had to cut rates back and forth, and inflation didn't really work its way out of the system until Volcker took the funds rate up to 20%.
They really need to put the genie back in the bottle as best they can. So after blowing it so badly in 2021 and 2022 in terms of inflation, I think they're just like, okay, this is our task. This is our defining moment. And that's why you have doves and the hawks all on the same page. And the other thing, Powell, I think, has been very genuine. He thinks, okay, and he said it again this morning in a speech overseas about, stable prices is the bedrock of the economy. Long-term, high inflation hurts those at the bottom of the wage spectrum more than anywhere else. So if we can bring inflation down, yes, there may be a blip up in unemployment over a window of time, but longer-term stable prices benefits those at the bottom end of the wage spectrum than any other factor. And so I think he's very sincere, and I think that's why the doves have kind of agreed and say, yeah, you're right. We need to get prices down. So, well, let's talk about the market reaction here then. Yeah. The dollar has been under pressure, but we're at pretty critical support. I know you don't have it on this chart, but we're trading at the this level right here is the breakout point from COVID when we did the COVID lockdown. So pretty important support, but you're looking at different things too.
Yeah. Also, that line right next to yours, that upward sloping line there, that connects several lows from the lows in 2021 and last year. So it's a pretty important trend line. I've had this highlighted for months. To me, the price pattern implies that you've had a 1, 2, 3, 4, 5. The bounce last week was a wave 4, and now we're going down. I think the dollar is completing this correction from the high at 114.77. You can see the dollar made a new closing low yesterday. The RSI didn't agree. So those are all preliminary signs, coupled with, as you point out, that horizontal area regarding COVID, the longer term trend line, the price pattern. Sentiment has become very bearish. And again, I think dollar weakness has been fed in part by a misunderstanding of what the Federal Reserve is going to do with monetary policy. Oh, they're going to have to keys, all that kind of stuff. I think that has contributed to dollar weakness. What this chart implies to me is that the dollar is near a trading low, and a rally up to the 107.50 to 108 level, I think, is likely. And then we'll just see the nature of that rally when it unfolds. But yeah, so to me, the things are kind of coming together. Gold, interesting. Gold made a new closing high. The RSI, it's a very small negative divergence, but it is a negative divergence. To me, the pattern implies that you can see that you've had a 1, 2, 3, that choppy rising wedge part was wave 4, and then this pop, I think, is wave 5. So I think gold is nearing at least a meaningful short-term high, and a drop down to 1750. If the dollar starts to run, we'll see if gold gets more weakness than just 1750. But I think we're near a high in the gold. And gold, to be perfectly honest, when it got above 17, I was bullish at 1630, said it's time to sell at 1770. So, gold has gone further than I had originally anticipated. But I think, to me, the price pattern sentiment has shifted very much toward, let's get bullish gold and all that. If the Fed continues to beat the table, no, we're serious. I think, as I said, the dollar benefits. Gold, I think, would have a reaction after making a really pretty big move.
So what's that mean for yields? You've been looking at bonds quite a bit recently.
Yeah. Well, what we can see is that trend line, that red trend line, goes back, I don't know how many months. It goes back a ways.
Yeah.
And what's interesting, we talked about it on December 7th, the 10-year got down to 3.402. Then on December 14th, we got a great CPI, and it only could get down to 342.3. That was a tell to me that, wait a second, this great report where inflation dropped under 8%, couldn't get yields lower. It held that trend line. We saw the uptick. I thought yields would go up to 385. They got over to 390. We came down yesterday on that trend line. They're up again. The 2-year got down yesterday to 419. Fed funds is at 437. So to me, talk about blatant in-your-face Fed. You're not going to do what you say you're going to do. The 2-year, to me, really shows that. So if I'm right, I think we'll see the 2-year tick higher. I think potentially, Blake, from the high that we saw at 433, that decline to 340 was wave A. We're in the middle of the B wave. So the move from 340 to 390 is A of B. The drop down to yesterday's low is B of B. And if that pattern's right, the 10-year should tick above 390. At that point in time, I think it's going to be a great buy, because I think ultimately that trend line, if I'm right about how the economy slows and so forth, that trend line, I think, can get taken out, and the 10-year can drop below 340.
Interesting.
But
So we should look for
term yields are going to tick higher, which again ties in with everything else. Yields start to tick higher. Is that supportive of the dollar? Yeah. Is it negative for gold? Yeah. It's also not a positive for equities if yields tick higher. So a couple things. I think there's a risk. Obviously, I think the CPI is going to come in with a 6 handle. And all of a sudden, now the street is looking for like 6.5, I think. So there's a chance it comes in at 6.6 and people are disappointed. Notice how when the S&P hit the 4101 high in December, that was on the CPI report. Got a big gap, boom, done. So as you look at the bottom panel, the MACD on the RSI for the S&P, and this is a 2-hour chart, you can see it's overbought. And if you look, every time it's gotten above that red line, the S&P's reacted negatively. So we're overbought. People, I think, are anticipating a good CPI. That could be a problem. From a pattern standpoint, from the high at 4101, to me, you can see very clearly 1, 2, 3, 4, 5 down to 37.64. The choppiness since then looks like some kind of a B wave. I mean, it's, you know, we've had since I think December 18th or 19th. The S&P's been chopping, right? That spike up yesterday may have completed that B wave. So what this sets up is you had a 300 plus point decline in the S&P from 4101 to 3764, 337 points. You subtract 337 points from 3950, yesterday's high. That's where that 3613 target comes. That would complete a big ABC. And then I think the market's oversold. Maybe they finally, oh yeah, the Fed really is serious. Then we'll be set for maybe a rally that does take the S&P above 4101. So I just think with the dissonance between what the Fed is just pounding the table and the market's ignoring it, the risk here is that at some point, oh man, they really are serious. And that to me leaves open the door for, you know, the S&P to pull back. Ultimately, you know, again, as we talked, I think 3,200, that's the 618 retracement from the bottom in March of 2020 to the high in January of 2022. I think a recession becomes more likely as we get to mid-year. And as I said before, that window of time where the Fed doesn't cave, like Wall Street has been conditioned the last 20 years at the first signs of real economic softening, is that window of vulnerability where the S&P could probably peel off 10 to 15% quickly. But then I think that's where you get the buying opportunity.
All right, Jim. Well, thanks for walking us through this scenario over the next several months. It's going to be interesting with the CPI data being released this week. I know everybody's going to be watching the report, so folks will be watching this video ahead of the CPI, and then we're going to catch up at the end of the week post CPI and see what the market did. So
this week has a twofer.
It does. It's a twofer since we missed last week. But I want to say, if you all like what Jim does, make sure you share it. If you see us on social media, LinkedIn, YouTube, Twitter, whatever, share it with your friends, share it with your family. Make sure you give them a thumbs up and subscribe to the channel so you don't miss any of this very exclusive content from Trader Summit. Thanks, Jim, for spending your time with us, and we'll see you later on this week.
Looking forward to it, Blake. Have a great week.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.